Mitchell Sabshon, the publicly traded REIT sector, as measured by the IYR, which was the real estate ETF, it's been fairly flat this year as compared to the S&P, which is up around 3.5%. So talk about your view of commercial real estate right now.
Thank you, Greg. I think the commercial real estate market is extremely strong right now. We've seen tightening of cap rates, dramatic appreciation in prices, arguably maybe even ahead of the growth of the economy. Clearly we have a recovery in the economy, a moderate growth, but just about every indicator is at 7 or 8 year highs. And yet we've seen cap rates even more aggressive than that. It's a great time to be buying commercial real estate.
Can you talk about what Inland Investments is holding right now? What's in your portfolio?
Well, given the growth in the economy, and we expect that growth to continue, we want to own real estate that has a preponderance of shorter-term leases. The last thing we want to own right now is real estate that has 20-year leases with little or no ability to increase rents, and therefore, if the Fed ultimately increases interest rates, fall behind that increase. But if you focus on real estate that has a significant amount, let's say, for example, apartment buildings, a preponderance of 1-year leases, or multi-tenant retail, anchored grocery retail that has maybe an anchor or two, but a significant amount of inline space where you can raise the rents. We're not an investor in hotels, but hotels have the shortest leases of all, one night rental periods. You can increase that rent. So we're focusing on opportunities where there are short-term renewal options to increase the rent, and if we manage our properties well, we have tenants who will begrudgingly go along with those increases.
And which part of the country are the hottest zones for you right now?
Well, we pay a distribution relatively higher than the listed REITs because our vehicles tend to be either non-listed REITs or private syndications. And as a result, we shy away from the top 10 or so, 10, 12 MSAs. We like strong secondary and tertiary markets. We want to be the best shopping center, apartment building, self-storage facility at Main and Main in that secondary or tertiary market. We can get the yields we want, and as I said, if we manage the property well, we can increase rents.
Inland Investments offers a non-listed REIT. Why is this preferable to buying something you can just buy that's listed right across the street over in the New York Stock Exchange?
Well, the presumption in your question, Greg, is that the wrapper doesn't make a difference, that a listed REIT is the same as a non-listed REIT. And I would disagree with that conclusion. I have no problem buying listed REIT stocks. You like the management, you like the portfolio, you like the strategy, you think it's undervalued, buy that listed REIT. But buy it because it's a good stock. It will perform in your portfolio like a stock. The non-listed REIT, not being listed on a stock exchange, is insulated significantly from the beta of the market. It's pure real estate exposure. And as a result, in a portfolio, to have pure real estate, you reduce overall portfolio volatility. So buy listed REITs to get that stock exposure, but buy non-listed REITs to have real estate exposure.
Are non-listed REITs also better if and when the Fed raises rates? Because whenever you hear talk about the Fed raising rates, sometimes it impacts the listed REITs.
I actually think it doesn't make a difference whether the wrapper is a listed REIT or a non-listed REIT. It really depends upon the kind of real estate that's owned. And as I suggested earlier, if you own real estate that's a 20-year lease, maybe flat or with very limited increases, periodic increases, it's going to behave like a bond. And if interest rates are raised, then that real estate will underperform. On the other hand, if you have real estate that has that opportunity to increase rents, then you will see it pretty much track. I also think that there's a tendency to think that REITs don't perform well, listed REITs don't perform well in an increasing market, but generally the Fed will increase rents when the economy is growing, and that bodes extremely well for real estate investment.
All right, thanks a lot, Mitchell.
You're very welcome, Greg. Thank you for having me.
And thank you for watching The Street.